Many companies, both large and small, use share incentives for key staff members. Now, if we stand back a little bit, the purpose of these incentive schemes is really to align the objectives of the company, which is in a lot of cases to maximize its profitability, with what the employees would be striving for. And that would then, if these two things are aligned, the employees would obviously be compensated if they achieve the same things that they can influence and that would drive up the company's profits. Now, the design of these schemes could look very different depending on the type of scheme that you've got and depending on the type of entity that you're looking at. So it might well be that the scheme implemented by a listed company and a private company look very different. However, if we stand back a bit and think about the tax considerations, there are a few core tax questions or considerations that are very common to a lot of these schemes, irrespective of whether you, for example, looking at the listed or a private company. So the question is then, what are these key tax matters that you need to consider when you are looking at an employee share incentive scheme? This is what I'll be discussing in this episode of Tax Break, the podcast for South African tax professionals and practitioners. Now, before I start, I would like to ask that if you like listening to the podcast, would you mind rating it on your favorite podcast platform? So it seems that the more ratings the podcast receives, the more the platform would show it to other potential listeners. And then, as always, I would like to ask you to consider if there's another tax practitioner or tax professional who also work in South African tax who you think might also like to listen to the podcast. If you don't mind forwarding the link to them, and perhaps they can also become a listener. Then, just a reminder, my email address is in the show notes. So if you've got any ideas, suggestions for other episodes, questions, and of course, if you need tax advice, please send me an email. Right. So back to our topic of share incentive schemes. Now, the idea to speak about these things came from, and to highlight some key pointers, came from a recent ruling that SARS issued in November last year, so Binding Class Ruling 91. I would like to perhaps, before I go to what these common tax considerations are, I would like to highlight a few aspects of the ruling, and that would also give you a feel as to what do you typically and often see in these share incentive schemes. Right, so firstly, the entity involved is a listed company, and actually it's the share incentive scheme for a whole group of companies that form part of this, that are the subsidiaries of this listed company. One of the subsidiaries is the applicant. The subsidiary administers the scheme, and then there are other entities who are the employer companies, and this is where the participants work. So the people who participate in the scheme, the key employees. Now, from the detail that's set out in the ruling document, it seems that the scheme and the awards are approved at the level of a group remunerations committee, so a group REMCO. And what the REMCO would do is they would determine a number of shares or a value of the award converted into a number of shares, and then practically each participant would receive an award letter. Now, this award letter would set out some conditions. The conditions are related to employment. So in other words, how long do you need to work for the group to get the shares, and some performance targets. And obviously from a design perspective, we're not talking about tax necessarily, but if you think about a well-designed incentive, these performance targets should be something that the individual is actually able to influence. Otherwise, what's the point of trying to align the target with what the individual is aiming to achieve? Right. This specific scheme works in a way that the applicant arranges with a stockbroker to go and acquire the shares in the market, and then the shares would be transferred to the employee. And this is then, again, terminology may differ from scheme to scheme. In the context of this scheme, this is referred to as settlement. Now, maybe just to highlight, in the context of an unlisted company, it's highly unlikely that you'll go into the market and acquire the shares. So your mechanism to get the shares to the employees might look a bit different. Now, why the settlement, the fact that settlement happens, so in other words, the shares are transferred into the name of the employees, why that's important. From the date of settlement, the employees are entitled to vote and they are entitled to the dividends in respect of these shares. But they are not entitled to dispose of the shares or encumber the shares until a future date. Now, this future date is the date when the conditions are met. So the employment requirement has been satisfied, and we know which of the performance conditions, or to what extent the performance conditions have been complied with. Then we also see some detail about what's referred to as good and bad leaver provisions. So what these essentially mean is that a good leaver may retain some of the shares if they leave the employment of the company, some or all of the shares, whereas a bad leaver could forfeit the shares for no consideration. So in other words, if you leave, for example, due to misconduct or having been involved in fraud, then you could forfeit the shares for no consideration. What is, in my mind, unique or not common to other schemes that I've worked with is that in this case, the bad leavers would forfeit their shares to a PBO trust that would then acquire the shares and would use that to try to achieve its public benefit objectives. Now, what is the detail of the scheme that's set out in the ruling also tells us is that once the conditions have been met, some of the shares will be sold back into the market or to the company to settle the tax and the employee's tax. So again, it may be that in a private company context, you need a different mechanism to give you the cash flow to pay the tax because there is no market necessarily for the shares. In a larger public company context where the shares are perhaps traded over the counter, there might be a different way again. So in this way, the small mechanics and how you design the scheme would look a bit different between different schemes and entities. Right, so let's get then to what the episode is really intended to deal with. Hopefully you've got a bit of a picture in your mind as to what the scheme that we are looking at, how it works and what it looks like. So in my view, there's a few things that nothing is new, nothing is unique, but there are a few things that this ruling highlight that would give you a good indication of what the tax issues are that you normally need to consider. The first thing that the ruling highlights is that the employer companies must withhold pay as you earn. So by implication, the other side of having to withhold pay as you earn is that the employee would be taxed on an amount. So these two are, one is the tax implication, the other one is the collection or the recovery mechanism. So there's a few things that the ruling then highlight for us that if you are dealing with a scheme like this, you need to consider. The question is, when does the obligation for pay as you earn and the employee to be taxed, when does that happen? And the ruling highlights it's at vesting. It's not when the grant is made, it's not when the award is made or when the award letter is given, and it's also not when settlement is made. Now, vesting in itself, it's got a very specific meaning in the context of Section 8C. That's the provision of the Income Tax Act dealing with these types of awards, share incentive or share awards. There's a very detailed definition of restricted equity instrument that would guide you to determine when vesting happens. So factors such as the conditions, the good and bad leaver provisions all impact when vesting may happen. Now, that's the when it happens. How much the tax implication could be, I think that we can also say it's not something that comes from the ruling, but from experience, I know that for different companies, determining the value may look a bit different. So if you've got a listed company where the shares are listed and traded on an exchange, it might be fairly easy to value the shares, whereas for a private company, the rules may need to have some sort of a formula to determine the value. Right, so that is the taxability of the shares. Now, what this ruling also highlights for us that I think is quite a useful reminder is that after settlement, so in other words, we've got the event of settlement, but then we also have the event of vesting that would happen sometime after settlement. If the employee received dividends between settlement and vesting date, the ruling highlights for us and it reminds us that these dividends are not necessarily exempt from normal tax. So there are quite a few complex provisions that could have the effect that the dividends are not exempt from normal tax. In other words, they become taxable as income. And that would be on the basis that they are really part of the person's remuneration package. So if you've got these dividends flowing before vesting, be careful and look carefully at those complex provisions. That's something one needs to consider. The third point that the ruling touches on, that's a good reminder of what to consider, is that there might be a deduction for this award that's being made by the employer or whoever settles this transaction. Now, the questions here would be, who incurs the expense? And is there even an expense? So the Supreme Court of Appeal a few years ago in the Labatt Africa case ruled that if a company issues its own shares, that's not necessarily expenditure. So the court's reasoning was that if the company issues its own shares, it's actually the other shareholders whose interests are being diluted who become poorer. It's not the company. So depending on how the award is being settled, there may or may not be an expense or expenditure to deduct. And importantly, even though IFRS 2 might show an expense, that doesn't tell you you've got your expenditure for Section 11A purposes. It's a bit more complex than that. So in this specific case, the companies didn't issue their own shares. They paid a cash amount to acquire the shares to settle. So there was the ruling confirmed that there was an 11A deduction. However, what it also highlights for us is that timing might be an issue. So if you look at these types of awards where the service and the performance conditions run over a number of years, then Section 23H would often come into play. And that provision really says that if you've incurred an expense, qualifies for deductibility, but the service or the benefit that you get from that expense will only be received in a subsequent year of assessment, then you need to align your deduction with when that service or benefit is received. The last one, or the last point that I would like to touch on, and I think I'm going a bit off the script of the ruling here. So the ruling highlights the fact that there could be a trust involved. As I've said, I've never really dealt with a structure where the shares are forfeited to a PBO trust. It might be that it's common, that I've just not come across it. But I think the point that I want to then carry on and build on a bit is that you may often see trusts in these structures in different roles. So, for example, the trust might be a holding vehicle of the shares until vesting takes place, and it could give you a mechanism to flow dividends through to the participants. So there would be some tax implications from as a result of the involvement of the trust that you need to consider there. It could also be that the trust has got even a different role, in the sense that it holds the shares, and instead of having to transfer shares to participants, transfer it back to the company when the participant leaves. What's being allocated is actually a unit or an interest in the trust, and that interest in the trust is awarded and forfeited when the person if the person leaves employment. So the involvement of a trust, in that case, the interest in the trust would perhaps be your equity instrument that you need to look at. So let's conclude. What are the few take-home points as far as key areas that you need to consider when you are dealing with employment incentive schemes that this ruling perhaps highlighted for us? Firstly, is there's an income tax implication for the employee. Closely related to this, the employer then needs to consider when and how much tax to withhold as pay as you earn. Secondly, if there are dividends that's flowing as part of the scheme, you need to consider the treatment of those dividends very carefully. They are not necessarily taxed as normal dividends would be. Thirdly, you need to carefully look at the deductions that the payer would be entitled to, or whoever settles the scheme. And fourthly, if you've got a vehicle like a trust that's involved as the holding vehicle, that becomes the vehicle in which the interests are allocated and forfeited, or that in this case becomes the vehicle to which the shares are forfeited, that does add a bit of another layer to the scheme that you would have to look at very carefully. Okay, so maybe final thoughts. I don't want to create the impression that these are the only considerations that you need to think of. My experience is that as soon as companies start working on these things and they make the scheme their own, they design a scheme for their needs, there are often finer nuances that they come up with to solve specific issues in their context. And these things would obviously have tax consequences that one would need to look at. But the four things that I've spoken about today are some of the more common aspects that you are likely to encounter when you are dealing with these schemes. So as always, I would just like to remind you that the podcast is not intended to be tax advice. It's for information purposes only. So I hope that you've enjoyed the podcast, and until next time, goodbye.